In a significant development that sent shockwaves through the global financial system, Moody's Investors Service downgraded the United States long-term credit rating from AAA to AA1. This decision, announced on May 16, 2025, marks a pivotal moment in American economic history. It is the first time since 2011 that all three major credit rating agencies, Moody's, Standard & Poor's, and Fitch, no longer grant the U.S. a pristine AAA rating. This downgrade, a direct consequence of mounting concerns over the nation's fiscal health, carries profound implications for the U.S. economy and its standing on the world stage. The downgrade, while not entirely unexpected, has nevertheless triggered anxieties about the future trajectory of the American economy. It serves as a stark reminder of the nation's long-simmering fiscal challenges, which have been exacerbated by political gridlock and a lack of consensus on long-term solutions. The ramifications of this downgrade extend beyond Wall Street, impacting the lives of ordinary Americans in various ways. Credit ratings play a crucial role in the global financial system. They serve as a yardstick by which investors assess the creditworthiness of borrowers, be it governments, corporations, or individuals. These ratings, issued by independent agencies like Moody's, S&P, and Fitch, offer a forward-looking assessment of a borrower's ability to repay their debts on time and in full. A high credit rating signifies a lower risk of default, making it more attractive for investors to lend money at favorable interest rates. Conversely, a lower credit rating indicates a higher perceived risk of default. This can lead to increased borrowing costs, as lenders demand higher interest rates to compensate for the elevated risk. For sovereign nations like the United States, credit ratings are particularly important. They influence the cost of borrowing for the government, impact the value of the U.S. dollar in international currency markets, and shape investor confidence in the American economy. Moody's decision to downgrade the U.S. credit rating stems from a confluence of factors that have raised concerns about the nation's long-term fiscal sustainability. At the heart of the issue lies the country's burgeoning national debt, which has ballooned to unprecedented levels in recent decades. The Congressional Budget Office estimates that the national debt now exceeds $36 trillion, a figure projected to reach a staggering 134% of GDP by 2035. Compounding the problem of rising debt are soaring interest payments. As the Federal Reserve has raised interest rates to combat inflation, the cost of servicing the national debt has skyrocketed, becoming one of the fastest-growing federal expenditures. These escalating interest payments are crowding out other essential government spending priorities, further straining the nation's finances. Political dysfunction has played a significant role in exacerbating the U.S. fiscal woes. Frequent debt ceiling crises, partisan gridlock over budget negotiations, and a lack of long-term fiscal planning have all contributed to a sense of unease among investors about the government's ability to manage its finances responsibly. Impacting the overall pace of economic growth. Section 5. Echoes of the Past. A look at previous downgrades. This is not the first time the United States has faced the unsettling reality of a credit rating downgrade. In 2011, Standard & Poor's stripped the U.S. of its AAA rating following a protracted political battle over raising the debt ceiling. This downgrade, which came amidst a period of heightened economic uncertainty following the 2008 financial crisis, sent shockwaves through global markets. More recently, in 2023, Fitch Ratings downgraded the U.S. credit rating, citing similar concerns about rising debt levels and political polarization. These past downgrades serve as cautionary tales, highlighting the potential economic and financial repercussions of failing to address the nation's fiscal challenges in a timely and responsible manner. They underscore the importance of political will and bipartisan cooperation in tackling long-term fiscal issues. Confidence in the government's ability to manage the nation's finances effectively. While the immediate impact of the credit downgrade has been relatively muted, the long-term consequences of inaction could be severe. If the U.S. continues on its current fiscal path without addressing its underlying structural issues, the situation could deteriorate further. This could lead to a vicious cycle of rising debt, higher interest payments, and slower economic growth, ultimately eroding the standard of living for all Americans. In a worst-case scenario, a sustained loss of confidence in the U.S. economy could even threaten the dollar's status as the world's reserve currency. This would have profound implications for global trade and finance, potentially leading to increased instability in the international monetary system. While this is not considered an immediate risk, it is a stark reminder of the potential consequences of failing to address the nation's long-term fiscal imbalances. The recent credit downgrade is not merely an abstract economic indicator, it has real-world implications for every American. From higher borrowing costs for individuals and families to potential job losses due to slower economic growth, the consequences of inaction are far-reaching. It is crucial for the public to understand the gravity of the situation and demand that their elected officials prioritize responsible fiscal policies. This includes engaging in thoughtful dialogue about the nation's long-term budget priorities, finding common ground on solutions to reduce the national debt, and restoring trust in the government's ability to manage the nation's finances responsibly. The path forward for the U.S. economy in the wake of the credit downgrade remains uncertain. The outcome will depend on a multitude of factors, including the government's response to the downgrade, the trajectory of interest rates, and the overall health of the global economy. Despite the challenges, there is still hope for a positive outcome. If policymakers can seize this opportunity to enact meaningful fiscal reforms, restore confidence in the U.S. economy, and chart a course toward long-term fiscal sustainability, the negative consequences of the downgrade can be mitigated. This will require political will, bipartisan cooperation, and a shared commitment to securing a brighter economic future for all Americans.